The population growth rate in Canada, obviously it's only got 1/10 of the population, but its population growth rate is 5x the US. So you got a position where you've got a shortage of supply and you've got the fastest growing sort of industrialized nation. Then I come to the US, which is where I live, but I come here, a year ago and I'm looking at a lot of markets going, who would build there? You may be surprised to learn that we don't spend money on any types of paid ads. So here we are, generally speaking, renting twice as many units in a month. Instead of 30 units, renting 60 units at the similar facilities without a single ad.
Welcome everybody to Self-Storage Income, and we have got an awesome guest today. We're talking about a few things that we actually haven't hit on a lot in the podcast. So this is going to be a really interesting one. I've already, before we even started it, I asked a few questions and I was like, no, hold off. I got so many questions. We're just going to have to wait till the podcast. So today I got with us Jason Koonin, and I'm really, really excited to have him on. He is the CEO of Bluebird Storage Management in the US and Bluebird Storage in Canada. So with that, bring you on. How you doing, Jason?
Doing great today. It's nice to see you, AJ. I'm excited to be on.
Yeah, nice to have you on. And I was looking at your stuff. I was a little confused out here because I saw Canada, then the United States. So we got to start just right off there. Do you own, operate, or manage in Canada, and then you live in the United States, or how's that all work?
Yeah, it's definitely confusing for a lot of folks. I got involved in self-storage 4 years ago, and I live in Winston-Salem, North Carolina. And here in Winston, I got introduced to somebody who was developing self-storage in Toronto. So that's kind of how the connection was made. And they had founded Bluebird Self Storage in Canada. And right when the pandemic started, I started a consulting engagement with them, which led, of course, into later becoming CEO and launching our own management platform. But yeah, I own and operate stores, what started in Toronto, but now across 6 Canadian provinces from coast to coast. And yes, I do live in North Carolina in the US and launched our Sunbird brand a year ago and the Bluebird brand in Canada 4 years ago. So working in both countries.
That's awesome. Now, how many facilities do you currently have under your two brands under management?
So Bluebird, which started a lot earlier in Canada, is up to about 25 facilities, say around 2 million square feet. They're pretty large facilities, so we've got 2 million feet there. We've got another 15 facilities under development, so another 2 million feet coming in Canada, so that'll be about 4 million. And then in the US, we've got 2 operating facilities and 8 others in development, all in North Carolina, so about 10.
So you have just a little development going on right now. You're kind of dipping your toe in development here with like 3 million square feet all at the same time.
Yeah, it's been quite the journey. I'm really fortunate that my partners, as well as some of our extended partners, are really fantastic in development. They've got tons of experience going back 30 years. Kind of grew up in the business, and I kind of came in more at the service level from a management perspective, but these guys really are development experts. So right now we're probably the leading developer across Canada, and their experience in the U.S. is pretty rich when it comes to places like North Carolina and Florida.
This is amazing because I've never had a guest on, I believe, that is operating in Canada and the United States. I think you are the first one in however many years our podcast has been going on that actually is operating in the 2 different countries, Canada and the United States. I'd have to look back to verify, but I'm pretty sure that's true. So I would love to hit on the differences, but before we do that, if we can talk about, you started out, right, in Canada and you were developing, right? Or were you doing this? So out of the 25 facilities you own, did you develop all of those, or were those acquisitions?
Yeah, it's definitely a mixture. I would say when I came along in 2020, right at the start of the pandemic, there was approximately 10 facilities that had been developed or redeveloped by my partners. all in the Toronto area. And subsequently, when I came on board, we decided to bring the management in-house. They were kind of developing, a very high quality Class A, trophy asset portfolio in the Greater Toronto area. And we felt like the management for it needed to be much more boutique-like. So we brought it in-house, and we scaled into places like Alberta and Quebec with acquisitions, as well as Nova Scotia, and then subsequently got some third-party contracts. So we're really growing in all three facets, but I would say predominantly it's development, followed by acquisitions, and then third-party.
I love it. Your model is very much like mine, except I'm more acquisitions heavy, and development, right, is much lighter for me. And that goes back down to, like, you can tell your core tenants, especially starting out with your partners on that development side, where mine was on the management side. That's how I started out. Then development kind of came later. Now, development in the last 2 years, though, that has been a tougher game. I know that it has been for us. There's been a lot on the capital side going on. How is that gone in the last 2 years with higher interest rates? Perfect example is Connor had the podcast with Forge Building, and they're one of the largest storage builders in the world. And they said that the amount of people that have canceled or deals that have fallen out, developments that have fallen out, is up over 120%. So, it's been rough on the development side, and, in a way they haven't seen. How has that been for you guys? And what does your process look like on that to enter into a market to make sure it goes to completion?
Yeah. So, great question. The answer, it's a little bit of a long answer. So, starting back, 2020, I started getting to the business. 2021 in Canada, things are going kind of gangbusters. Rates are still low. Banks are still lending, and demand is pretty strong. So 2021 was good. Towards the end of 2022, as rates start to go up, that really hit us first on the acquisition side. So we had grown pretty quickly in 2021 with acquisitions, but as rates started to rise, it was really hard to get equity. So we have, I said earlier, about 25 facilities across Canada. I think if we had the capital through the pandemic, we probably would be sitting around 75 facilities. So we've just been capital starved for the last 24 months. We noticed a change probably this year starting, I'd say, around May. Equity started to flow again. Banks started lending again at the start of the year. So,
exactly like that. Literally, May was the turning point for us, both on equity and capital, where we started to see a change. That's interesting.
Yeah, exactly. So the 18 months leading up to that were just brutal. So we were just happy to kind of survive and get through it. But it was a lot of fun in 2021. We're growing like a weed, and then just kind of going sideways after that. So things are starting to flow again. When it comes to development, we can make deals pencil in Canada for a lot of reasons. The demand remains strong. The available supply, if you use very round numbers and you say, okay, in the US, you're looking at maybe 9 square feet per capita. In Canada, there's only 3 square feet. So there's only a third of the supply. And in many of the markets we develop in, we're looking at getting annual rents on the order of between $30 and $65 a square foot. So we can make those deals work. Then I come to the U.S., which is where I live, but I come here, a year ago, and I'm looking at a lot of markets going, who would build there? So we get calls every week now, every couple of weeks, from developers who conceived the idea of building storage, in the heyday, 2021. Now the projects are, nearing completion, and they don't know how to make them work. So yeah, as you said, higher interest rates, lower street rates, it's not a good recipe for developers.
Overall is a real good thing for our industry, because we needed a pause. It was out of control. I mean, you go back to 18, 19, 20, and 21, and it was wild. I couldn't even believe it. I mean, you go into any city, and there was just storage everywhere being constructed. And so I think it is something that in the long term is good, because it was so skewed during that time everybody was full. Rates didn't matter. Everybody was rising. It was just like, no matter what, everybody's going to win. And you could make as many mistakes as you wanted. It didn't matter because in 2 years, rates were going to be 40% higher, right? And that created a real big boom. And I think coming back down to earth and returning back to how storage was, right, is causing us to rethink and go back to fundamentals of development. Why? Because you can't just develop a facility and sell it at a 4 cap anymore. That doesn't work. So developers have to look at operations, management, what units sell. Like, we're back down to where it should have always been, fundamentals. And I do think that's a good thing, but that also, though, creates very challenging markets. When, like you, we looked at, it was something like crazy, like 80+% of all the markets we looked at, we couldn't figure out how to make developments pencil, like at all. Like, it just didn't make sense where rates were in the last 18 months and where buildings costs were. It's like, it just doesn't work, right? And then you tie in interest rates and everything on top of that. So we've had to become more selective. And you guys, are all your buildings kind of A-class, institutional grade looking facilities? Is that what you're building?
Yeah. I mean, that's kind of the segment that kind of fits our operating strategy. So our typical building in the U.S. is, they're all probably 3 stories. So heated, air conditioned mostly. Around 90,000 square feet gross in the U.S., 120,000 feet in Canada. It's a prototypical building, but the space is quite crowded in some submarkets. So as you said, you got to be very selective. We talk to a lot of first timers. They're not really prepared for the capital required to not only develop, but to survive the lease up period, especially when it's going to now take a normal amount of time, which we underwrite 3 to 4 years. So it's very challenging right now. And, any way we can help folks out there, advise them, we're happy to. It's not easy to be a first timer right now.
No, it's not. Especially on the development side.
When you guys are looking at property management software for your storage facilities, there's a ton of options out there, but no other option compares to Tenant Inc. Tenant Inc. is going to be your one-stop shop solution that has an amazing amount of tools that you can deploy at your fingertips to maximize the value of your facility, to operate it more efficiently, more effectively. They have an open API where you can back in almost anything you want. You own your data, and it's just an incredible solution. I can't say enough good things about these guys. Link is in the show notes. Be sure to check out Tenant Inc.
Now, let's talk about your acquisitions. What is your philosophy on acquisitions? Is that something you're really building out, or are you more development focused?
This is an interesting question because, I'll talk about Canada for a bit just because that's where I've operated longer and, seeing these two things play out. So the acquisitions were, as I said, flowing, in 2021. But since then, as interest rates rose, investors, despite the risk, of course, that comes along with development and lease up, they preferred the development returns, given where interest rates were, 8-10%, they wanted to get returns, closer to 20%. So they're stretching for yield and really going for development. So the market really kind of shut down when it comes to acquisitions. So our focus, obviously right now is just trying to raise the equity, but once we have it, things that fit into our, sweet spot is we're going to be looking for certain types of demographics, higher income areas, less supply. If we're acquiring, then we want larger scale facilities. We can't really make our model work at all with less than 40,000 rentable feet. It just, we have to use more of a lighter version, more remote management, stuff like that. But, we'd rather have 80,000 square feet of rentable space where we can have 1.5 or 2 full-time staff and kind of run that playbook. We feel like the operating margins are so high, you're starting to push 75% with a larger facility that with a real small facility, you're in the 50-60% range to deliver the service level that we deliver. So it's most of the stuff that comes across our desk, 99% of it just doesn't fit based on size and quality.
We feel the same way. One of the things too, even with the operating costs have increased so much, and with the rate decline, that's really hit smaller facilities harder. Now, there's some smaller facilities that haven't had rate decline and everything has been able to operate them, but we've just seen such an increase, primarily too in the cost of acquisition of the customer. The cost of acquisition of a customer over the last 4 or 5 years has just skyrocketed, right? So I own small facilities and I own them in small markets, right? But it becomes very, very hard, right, to maintain those margins when it only takes a few things to happen that can really blow that margin out of the water. And so, because you just have less revenue. And I think a lot of people have figured that out, especially on the acquisition side. Now, when you guys are looking at the markets that you're looking at, what is your primary market? Are you after first tier, second, third tier, east? Are you simply in the Carolinas, or, where's your target markets you guys are looking for?
Yeah, that's another good question. I think we can cover that, as well as some of the other things you touched upon, like acquisition costs and pricing. In terms of target markets, my view on it has been much more, I would say, open-minded than many of the sort of institutional investors that I come across, which, as you know, they're very much, only willing to go into, major metropolitan areas in a lot of cases. They're not interested in what they would term, secondary, tertiary markets. I mean, we've had above average returns in many, if you will, secondary markets across Canada. So what we really look at is that sub-market. So if we're looking at a trade area, where are most of our customers coming from? They're coming from, 3 miles, or 5 kilometers, in most circumstances. Sometimes it's a little bit narrower in a very dense urban area. Sometimes it's a wider net in a more rural area, but by and large, people are coming from a 3-mile radius. So I personally don't really care as much, am I in a big city? Because I can be in a big city and have just a ton of competitors in every corner, or I could be in a growing suburb that's considered a secondary market and have incredible returns. So we're willing to look, frankly, anywhere, and we start with an address and we do the work.
Let's go back then to I think that I follow you exactly on that. I think that, especially in storage, it doesn't follow normal real estate. And I think the limitations of basic principles of we gain our equity by the increase in the markets, and that's why we want to go after first-tier markets because of appreciation and rents. It doesn't work quite like that in storage, so I think that's very limiting. But let's talk then, and going back to the management side, right? You were brought in for a lot of the management. You started third-party management. And we've seen the cost of acquisitions of customers go up. We obviously have the expenses overall have been rising. We've also, in that turn, had a softening in rates and occupancy because of higher interest rates. Talk to me about that environment, what you're seeing in this environment, which is different from the last 10 years, right? In this environment, what's important to you? So to run and operate a facility successfully, keep your margins, what's your focus? And how are you doing that today?
Yeah, no, it's really interesting. And, I'm not sure you know too much kind of about our philosophy, but I've certainly listened to your pods a lot, and you guys are, the most knowledgeable in the industry. So I always learn a lot. Our strategy, though, is quite different. I've heard you say a few times how you're seeing rising costs of customer acquisition and things like that, rising expenses. A couple of things, first and foremost, my focus from day one has been to build sort of a premium brand. And with premium brand, I'm focused very much on top line revenue. I know many of the larger competitors, which is typical, not just in storage, but in any industry, right? When companies get quite large, they start to have a very, very tight focus on expense cutting, expense controls. And I think that's critical if you've got especially smaller facilities. But because we're really trying to drive the high-end customer experience, which allows us to attract customers who are less price sensitive, we end up with higher than market average pricing. The customer acquisition cost for us has not increased significantly, despite the competitiveness in a number of markets. You may be surprised to learn that we don't spend money on any types of paid ads.
That's okay. This is cool. Tell me more, please.
Yeah, so we've done a lot of testing, and sort of Canada was our laboratory initially, and now in North Carolina. But What we saw was because we had properties that had been managed, using a REIT strategy, which was very heavy ad spending. You're talking, $3,000, $4,000, $5,000 a month per location. We tracked the kind of rental activity which we got from those ads. In many cases, we were only actually getting, 0, 1, 2, 3 rentals a month from those ads. Total rentals a month at an average location might have been 30 or something like that. Then we shut off all the ads. We invested in a better website, in SEO, and obviously you've got to have a lot of patience. And fast forward, I think SEO typically works best, certainly after you get through the first 12 months, building out the keywords and your geography, and definitely, into years 2 and beyond. So here we are, generally speaking, renting twice as many units in a month. Instead of 30 units, renting 60 units at the similar facilities without a single ad.
That's amazing. I absolutely love that. We focus a lot, like our ranking in Google, right? Our SEO, everything else. But I still think that the ads can be a crutch. And the ad and ad spend can be a crutch for our lack of optimization on the website. And so I think like what you're doing is saying, let's really do this the right way, become the premier listing online, right? We don't have to have that. Whereas other people, including me, we say, yeah, of course that's important and we're doing it, but it's okay. We'll just up ad spend. And so that becomes this crutch to where we don't utilize that and do that. And in the long run, frankly, your strategy's better. If it's really working and you're doing it right, it's way better because the ad spend has gotten so big and it's so much to fill up units and everything else. Now, it does take a while, but I'm interested to hear on that. What are you doing to try to speed it up? Because as I understand it, right, I mean, you mentioned like 12 months, things like that. That's way faster than what I've imagined or thought of. So what are you guys doing to try to accomplish that to where you could get, I mean, if you can get off ad spend, that's incredible. Like that, props to you guys. That's amazing. You're the first person I've talked to that's ever done that. So that is fantastic. I'm excited for you.
Yeah, no, I appreciate that. That was probably one of the biggest bets that I made. I kind of bet the whole company on a number of different, strategies, but, probably the biggest bet was made on, moving entirely away from ads and going, taking all of our digital marketing to SEO. So, when it comes to getting rentals, right, through digital marketing, you've got to first get the traffic, like you said, from the rankings. So then you've got to convert it. So I think that's another key piece. And the reason why we're able to excel at both of those is, in a typical month, if we're spending, let's say across my 25 locations, I'm spending, $1 million a year, right? So if I've got $1 million in marketing, if I give all the money to Google, right, my website hasn't got any better. And each month I get, 3 paid rentals or something, some very low number for each location. Instead, if I'm willing to be patient and invest, now I've got, let's say, 20 rentals coming in from, organic search results. Because I'm not only driving more traffic, I'm driving higher quality traffic, and I'm also converting because the $1 million doesn't go to Google, right? It goes to my marketing agency, which is then optimizing the website, right, for conversion. It's making a website that's really easy to use on desktop and mobile. It's got all sorts of information as well as ability to navigate, which allows customers to feel comfortable and to give you their credit card. So that's probably one of the biggest breakthroughs. And then that feeds into, how we price, right? I can't charge premium prices without having obviously a high quality facility and service level. But if I don't have the demand, right, then I can't determine my pricing level. I've got to be more of a price taker and sort of price to the general market. Whereas in some markets, our prices are 30, 50 or 100% higher because we drive traffic.
Now, are you using websites like Sparefoot?
No.
Okay. So it really is organic. Honestly, you take Google and companies like Sparefoot, and it's like, geez, there's half your margin. It's ridiculous. Like it's hijacking the customers and holding them hostage to us. So finding, for people listening here that are looking to get in storage or first-time storage people, I want you to realize the power of what Jason just explained. It is probably one of the biggest, I believe it is the biggest problem for storage operators. And that is the fact that we've come into a system where 85% of our customers, we get through this thing right here, mobile phone, for those that are listening, and that what's happened is the aggregators, right, like Sparefoot and others, that all they're doing there is they're setting up a site where you can go pick anyone, and then they charge us, which is really high. And then you have Google, who says, okay, we have all the traffic. You have to pay us to get that traffic, right? So all of that is that pay for customer part. That has originally, that was like one of the best things ever, because it cost us nothing to do it, back in, 2007 to 2016, 17. And so it was like this amazing thing where it was so cheap and we got so many customers. But that's turned into the opposite, where once they have all the customers, they can jack up prices, and the cost of it is incredible. So now we're losing literally months of rent just to get our customers. So I think it's really important, everybody listening, that they understand the impact of what Jason just said and is doing. It's probably, once again, I believe one of the most impactful thing, if you could get around that and control your own customer by controlling your own platform, it's probably one of the best things you can do as a property management. Now, let's talk about the acquisition of the customers. Is it all online based? How do you support that acquisition of customers? Like, what is it? They just click online and go through to the site? Is it a normal, or do you have a sales team? How do you work that?
Yeah, it's pretty much all online. Almost all the rentals, I would say. Broadly speaking, half the customers will find us just because they know where our facility is. It's a typical drive-by walk-in traffic. And then the other half is predominantly just organic search. They're going to find us either on the map pack, or they're going to find us in the organic listings. And, we sort of pride ourselves on trying to outrank those aggregators, right? I don't need to pay the aggregator for their traffic if I'm outranking them. We've gone into new markets, and I think you'll find this interesting, AJ. As we transitioned, I shouldn't say transitioned, but as we embarked on kind of our U.S. journey, which is obviously more competitive than Canada, we were cautioned that it would be very competitive and hard to outrank, a lot of the larger players. But within our first year, right? Keep in mind, our first U.S. location on a brand new domain. We had a top 5 ranking in Winston-Salem. We outranked a number of public companies.
Wow.
So that in and of itself, it all kind of fits together, right? Our strategy has a lot of things that have to work in concert, from the size of the facility, the quality, the service. I think the way the industry has trended in the past couple of years is, as demand has waned, you're seeing street rates fall. Then, of course, you're seeing expense cutting, which means, service falls, service levels fall, cleanliness falls. So all of our things have to work together, and we don't want to rely on the ad spend or Sparefoot, like you said, as more of a crutch. We want to continue to have that, steady, high quality organic traffic. So that's been really critical. The other thing I wanted to add, you said, how do you make that work? And this sounds like it's faster than it normally takes. Well, let me give you an example. When I first got in the business, I couldn't believe how expensive marketing was. I was very naive. I came from banking. I was just worried about, how much we're spending. And we only had 3 or 4 facilities. We couldn't even figure out how to spend, like $1,000 a month per facility. It was really, really pathetic. And, what I've come to learn is really this kind of organic search journey begins much earlier than you would think. At first it was, we're getting ready to open a site next month. Let's start running ads, right? Or let's start our marketing. Now it's, hey, we've acquired a piece of land, in Charlotte, North Carolina. Great. It's going to take us, 18 to 24 months, right, until we open our doors. We're now throwing up a, coming soon page. We're now priming Google. If we're going to, and our facilities are different, right, than the average facility. But if we're going to go and build a $10 million facility, right, we're going to spend, $15,000 during the development phase to make sure when our facility opens, we're on page 1 of organic search.
Like I said before, that's game changer, especially when you're developing. I absolutely love that. I think that's fantastic. Now, talk to me about your operations then, running the facility. what is your average expense level? Do you know?
Yeah, I think, if I think about a stabilized facility, for example, as I mentioned earlier, we have fairly large facilities. We command, fairly premium pricing. So our operating margins are in the 70 to 75% range. So you could think about the expense cost, 25 to 30%.
And is that expense load, you think, a lot of people, when they're looking at those expenses, there's a few things that go into it. Not only the expenses of the actual management side, but we also have the revenue generated. What I'm saying by that is the bigger the facility, the higher rents you achieve, the lower your expense ratio is. And because there's more revenue, right? So if you had a facility that was getting 50 cents a square foot a month, right? And one that was getting $1 a square foot a month and had the exact same expenses, because it takes the same to operate that same square footage, very different in expense ratio. So do you think that plays a part into it? Is that the size of the facility and rents, or is it the optimization of your expenses?
Yeah, it's definitely not optimization of expenses. I mean, we definitely spend a lot of money. We probably spend, more than most operators, because once again, we're spending money on things like, staffing, right? We're paying above market wages. We're paying monthly performance bonuses. We typically have 2 staff. So we incur a number of expenses. So, my philosophy is we spend more than average, but, we make significantly more on the top line. So net, it's got significantly positive benefits for NOI and property values.
We hold the same to be true. So that expense load, changes obviously at stabilization. Our expense load, especially at acquisition, can be much higher for the first few years because we're turning around the facility, we're building it up, but also because we're moving it from a low rent per square foot to a higher rent per square foot. We're optimizing it, and we need to go through a few busy seasons and things to accomplish that. So the expense load, drops, but we aren't going cheap. That's not something that we believe pays off in the long run, obviously. Now, one thing I did just think of, your SEO that you were talking about and everything, going back to that just real quick, are you doing that in-house, or is that something you farmed out? Or how did you go about saying, we want to accomplish this? Was that something you took on within your company, or did you just go and find somebody that could help you?
Yeah, this is a really interesting part of the journey. As I mentioned early on, kind of moving the company away from, the typical, website at the time. We had been REIT managed. There were no online rental capabilities. There was primarily paid ads. So we were getting, low quality traffic. I met a marketing agency here in Winston-Salem. At the time, they were called New Agency, and they had done a bunch of work for non-storage companies, but your typical home services businesses. So they were building websites and doing SEO for things like roofing companies and home builders and remodeling companies. And I got introduced to them, and they were the ones who built all of our digital tools and website for Bluebird in Canada. Then they began to see this great opportunity within storage, right, to sort of revolutionize self-storage marketing by using SEO and moving sort of away from paid ads. And the benefit that they brought is they had a number of tools and techniques that had been used in all these other businesses, right, like virtual tours and e-commerce and a number of techniques, for SEO that they could leverage from their experience as an agency versus just being a self-storage pure play. So they're bringing the best of like the retail world and the home services world into storage. So they've rebranded as a company now, which is called Storagely. And they've done all of our work in Canada and the US. And I think having an agency, provides that sort of global view where they've worked on so many industries that they can bring the best tools of all those industries to bear for the sake of storage. And, storage marketing hasn't evolved that much in the past, 20 years. There's still a lot of old technology and techniques and a lot of reliance upon paid ads and aggregators, as you said earlier. So I think the Yeah, the opportunities to sort of disrupt the marketing space have been pretty significant for them, and we've grown and they've grown, and they continue to bring on new customers within the storage world.
We do the same. I love that. We use third parties. We're not that expert in it, and I think that is extraordinarily important to get experts in what you're doing. So I love that you took that route and the initiative to find it and align with your overall what you're trying to accomplish in your business plan. Now, I want to talk to you here just a little bit about what you're seeing in the industry now today and where you think that it's headed. So I want to start with the industry first, and then I want to talk to you about your company. With everything that's been going on, what is your take right now on the industry? And what are you guys planning for over the next few years?
Wow, that's a tough question. We've been through these, if you will, different seasons, right? We've had the pre-pandemic, which I wasn't really in the industry, so I can't talk too much about it. Then obviously we had the tailwinds of the pandemic years, and now it's become a bit more challenging. I think, as I mentioned earlier, the combination of the higher interest rates and the really aggressive street rates from large operators. We're seeing, if you will, teaser rates with then, subsequently large rent increases after only a few months to existing tenants. That is quite challenging. For us, specifically, we're trying to sort of chart our own course and stay out of that fray. And I think we're able to, for a few reasons. I mean, one of the things I like to talk about is differentiation. So, we know kind of our swim lane. We know our strategy and our strength is to have high quality, large facilities with, exceptional customer service, something you would experience maybe in a hotel or a fine restaurant. And because of that, we can't engage in a price war with a large operator, right? I mean, it's kind of nuts for us to try and do that. Now, if we had, a very small facility, remote managed, right, we couldn't really offer a differentiated product. So here we are, we have a pure play commodity and we're just a price taker. We know the lease up is going to be a little bit slower because the demand in the whole market seems to be down, double digits from prior years. So lease up is going to be a little slow, but at the same time, our prices are, let's say twice the market price. So competitors offering, $10 per square foot rents, and we're at 20. And the reason is because, if we're trying to maximize our revenue, right, not just our physical occupancy. So if we cut our rates by half, we're still not going to get twice as many rentals, and that's the whole challenge for us. So if we get into this race to the bottom and we start cutting our prices, we just can't generate enough revenue to service our debt. And we also will impair the value of our property. A lot of property values are based on the gross potential. And if we slash our gross potential in half, it's just got all sorts of negative implications for financing and for, investor returns and property values. So we're staying the course. But with that, I'm not entirely, tone deaf to what's happening in the market. I think for, smaller facilities and smaller operators, I think it's a very difficult time. I think there's folks who we've heard from who are looking for strategies and ways to deal with their debt stress, right? You've got record high debt service needs, and you've got record low street rates. So if they don't, they've got two ways, right? They can either sort of, hold the line like what we're doing. I know you've talked at length about how you tried to hold the line for a while and you had some places where you had to really compete on price, but you also have a larger portfolio. If you're a very small operator with, only one or two locations and a lot of debt stress, this is a very difficult time.
I completely agree. And it's amazing to me, at the diversity, or particularly in the United States, on how the markets have changed. So, we see markets where we have tons of pressure and markets where we have very little. And so I know operators are experiencing very different things across the nation. Now, what do you think are the major differences between Canada and the United States in the storage industry?
Yeah, I spoke earlier about things like the supply the supply is much less in Canada. You know, when my partners first started developing storage as far back as 2000 in Toronto, they had been pretty active in Florida, but decided to go to Toronto, where they had, you know, where one of them had been born, and his dad had been from as well on the development side. Canada has not only a shortage of supply, but you know, 10 or 20 years ago had very little Class A product. So in the U.S., we sort of take it for granted, right? You see lots of typically REIT owned or REIT managed multi-story Class A facilities. In Canada, even today, there's very little Class A product outside of places like the Greater Toronto area or Vancouver. Most of the country is, you know, Class B, Class C product. A lot of it is no climate control at all. Some of it has heat, but very little multi-story. So the product mix there is very different. The supply is different, but demand is very strong. So the population growth rate in Canada, obviously it's only got 1/10 of the population, but its population growth rate is 5x the US. So you got a position where you've got a shortage of supply, and you've got the fastest growing sort of industrialized nation.
Competition there is probably quite different.
I would say I would call it moderate. You know, I wouldn't say that it's low. There are a lot of cross-border players. So, you know, there's a large publicly traded company based in Canada, and then there's 3 or 4 very large U.S. players that are cross-border. So we do run into them in some markets. It's so how do I compete with them is by being sort of differentiated, right? By being not, if you will, like a very large, you know, chain, right? I don't want to be Walmart. You know, I want to be Ritz-Carlton. So we have, you know, very high-end facilities, very good locations, and then we hire the best people. At the end of the day, if you want to get customers to pay you a fair value for the product, you've got to deliver exceptional service. When customers have an issue, or when they want to rent, they've got questions, you've got to sell to them locally. We do have a care center, which we use, but it's really only for like rollover calls or after hours calls. So 90% of our calls are taken first and foremost by the local staff. So that's a pretty significant difference from most large operators, which are using like call centers to take all their calls. So we're trying to keep the service level very, very local. And I think that that's made a difference in kind of differentiating our brand experience. And because of that, we can, you know, not only drive the traffic and the occupancy, but, you know, we get questions, you know, well, you can't increase occupancy and price. I think you can if you have great service and great marketing.
When listening to you speak, I love how you say, this is who we are. We know who we are. We go to this place. We do this thing. This is how we compete. And we want to be the best at that. That simple approach, right? That pays off in dividends, but it also aligns the focus through operations. So we know how to operate for this individual, this market, and we can perform that and be the best at that. And I think there's huge value in that. And it's something that obviously your ethos is built into the company, and that's, you know, what your focus is, and you've done a very good job of that. And I think that's awesome. You've got so much development going on. You've got, you know, all these properties. You're in 2 countries. What does your actual management company at this point look like? How many staff do you have under your management?
Yeah, that's the interesting part, you know, about this business. You know, if you're on the real estate side, you know, as an owner, obviously it's quite capital intensive. But when you're on the property management side of the business, it's not capital intensive, and it's not really too labor intensive. So, you know, you can measure our people, you know, in dozens. It's not like we have, you know, hundreds of people. We have a very lean team, which I think is really important to running any business. I mean, having come from banking and, you know, not having been a lifelong entrepreneur, that was, you know, sort of a terrifying transition. But I wanted to make sure that the company was going to be sustainable and durable. And we've gone through a pretty rough patch for a relatively small company, right? I mean, after you get through the first 2 years of the pandemic, I mean, the last 2 years have been challenging for a relatively new company. And as you know, sometimes your portfolio grows through acquisitions or through new third-party management contracts. But the way we're structured, we're susceptible to investor sales. So if they wanted to exit a property, or in our case, we had a large investor group last summer sold 10 assets in the Toronto area at a very significant profit. Sort of setting, I would say, probably a lot of records for transaction prices. But as a property manager, right, that hurts, right, when you lose, 10 assets under management and the property management fees. So we're able to navigate that and some of those challenges by keeping a very, very lean back office. So we always want to make sure we have enough staff to manage the properties to kind of our premium standard, but at the same time, there's not going to be a lot of fat in our organization, which allows us to be nimble and to be able to survive some of the leaner times.
That's awesome. Well, hey, man, I really appreciate your time and hearing what you guys are doing. Fascinating conversation, and I think a lot of people learned a lot and can take a lot from this. Now, where, we have a lot of listeners, where would we direct people to learn more about you, hear more from you? Where should we tell people to go?
Yeah, I think the best place to start would be sunbirdstorage.com. You can kind of learn about our operating philosophy. There's a way to contact us. You can read about the Sunbird difference and sort of how we operate differently. You can see our different locations, some images of the types of facilities that we build. And if people have questions, if they have feedback, suggestions, or if they want help, we're happy to help the industry. We certainly take great pride in being good industry partners. And the other thing that we really pride ourselves on is being, good stewards in our communities. So we do a lot with respect to nonprofit organizations. So if there's organizations out there that could use free storage to help their organizations grow, and use that money to help more people in the community, we donate, I think right now over 10,000 square feet across Canada, and we'd like to donate more. So if you're a nonprofit and looking for ways to save money on your budget, and you need free storage in any of our markets, just reach out. That's as important to us as the returns to our investors, and we feel like if we can grow our communities, we can grow our brand as well at the same time.
That's awesome. I really appreciate you, man. Appreciate you coming on here. With what you guys are building and have in the works, it's going to be exciting to see what you become here in the future, because you are on a massive trajectory and you've really got this figured out. So thank you for coming on and sharing your expertise and journey with our listeners. And we look forward to seeing you again.
Thanks, AJ. Appreciate it.